Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to share with you what's going on in the market. I thought it was time for a market update. I get asked for these quite a bit. Should be a fairly quick video. I just want to let you know what's going on in the world of interest rates here as we, have now rounded out the first quarter and moving into partway through the second quarter already. And I got to be honest with you, all indications were at the end of last year that we were going to see potentially a lot lower interest rates really starting about this time here in 2024, right? I mean, the Feds were expected to potentially do a rate cut as early as, I think, the meeting in April, or was it the end of March? And then there was a lot of talk about June. And now, it's feeling like the Feds may not cut rates at all. I think the current projection is for 2 potential rate cuts this year. That's what's on the dot plot. And probably not until, the second half of the year, the fourth quarter even. I think there's maybe a little bit of thought that maybe in September. But I got to be honest with you, the more I look at it, the less it seems like the Fed's are going to do a rate cut. I'm going to get to that in just a second. But I do want to cover a couple other things that I just see going on in the market, different updates that I've reviewed that I wanted to share with you guys here today. So the first thing that's a little bit crazy is that mortgage applications are actually up year over year. So it's surprising that we are kind of reaching a point of interest rates as high as they were at their peak. We're back to that level. I think we might actually be close to all-time highs with interest rates, but yet mortgage applications are up. Not hugely surprising that we see more activity, being that it's spring and that's the normal time. But man, in the face of home prices and affordability and interest rates being so high, it is surprising how resilient it is. But mortgage applications, in fact, are up. Oil, I did an episode where I talked about oil prices, and I had some concern that this could be something that could derail or be part of what might disrail an improvement in rates here in 2024. And it's unfortunately kind of playing out that way. Oil pricing is definitely going up. And that's going to put pressure on inflation, obviously. And obviously there put pressure on interest rates as well. Typically, as oil prices go up, so do interest rates. And so that's not great news. Call options are at an all-time high on oil, meaning people are betting on oil going up. So not a good sign. It's not really surprising with some of the unrest in the Middle East and whatnot. But just something to keep a close eye on if you want to know what interest rates are going to do. Keep an eye on oil. It's going to play a factor. Rents have been high. Matter of fact, on the last CPI report, rents were up a bit and, causing more inflation. But they are showing signs of weakness. You can see where, rents and that whole housing kind of shelter component had improved significantly. And now they've started to pop up a little bit. Not great for interest rates. Good if you're an investor and you own rental properties. But rents have popped up a little bit, but they're starting to show longer term, maybe some weakness again. So we might see another step lower in rents. So keep an eye on that as well. But I thought that was very interesting. Asking price of homes is at an all-time high, forever, a forever high for asking prices. So that's interesting and definitely having an impact on affordability when you combine that with the higher interest rates that we see. The overall general consensus of the market is that it's good. I mean, better than we kind of expected here in 2024. Retail sales, the last 2 reports were up. Matter of fact, the last retail sales report came out on a Monday after, that bombing that happened in the Middle East. Luckily, the Iron Dome, caught 99% of those drone strikes that came from Iran. But nonetheless, it was usually something that you would see cause a flight to safety, and typically you would see interest rates get a little bit better. Retail sales came out and overshadowed, that whole event, which is a little bit shocking. And I was on a podcast around the time that happened, and I joked that war is good for those of us in the mortgage industry. I just want to clarify, obviously, no war is good war. It's horrible to hear, and probably not a great, even correlation. But the reality is that mortgage interest rates, when there's instability, whether it be war or other, negative things that happen, they tend to benefit the bond market. And that was my only point there. I think those of us in the mortgage business know that. I mean, look at COVID as an example, massively disruptive to so many people. People lost their lives, disruptive to, the economy, but yet those people in the mortgage industry had record years they'd ever had. Home prices soared, so on and so forth. So unfortunately, we work in an industry that tends to benefit during times of duress in other areas. So it is still interesting to see when you have that sort of conflict in the Middle East, and yet it's still overshadowed by other market factors. It really tells you that, people are really watching closely what's going on with the economy and what that's going to do to the Fed taking action to lower rates. And that was my next point here, is that at this point, the Fed doesn't have a lot of good reasons to cut interest rates. I mean, we continue to see strong employment. Retail sales is good. The overall economy appears to be good. Now, I think that we could probably go and say, do we trust all of these numbers? Do we trust the employment numbers and the way that they're calculated? Do we trust the way that some of these things are being calculated? But on the face of it, if you're just looking at the economic indicators, things appear to be pretty resilient with the market. And that's what the Fed's going to be looking at. And unfortunately, that means at this point, they don't have any good reason to make a rate cut. And as I mentioned, I think we went from thinking there would be, the market was thinking as many as 6 rate cuts. The Fed had said 3. I think we're down to maybe 2. And a lot of people are talking about no rate cuts. Matter of fact, my friend Ryan Hills, who's been on this podcast a couple times and does the RE Source weekly video that he puts out, he talked about this idea of a no landing scenario, right? So we talk about, is there going to be a hard landing or a soft landing as a result of the action that the Fed has taken? And I think originally there was very high expectation that the Fed moved, they were late to move. They've moved too quickly, too far, too fast, and that was ultimately going to cause a recession, which would be obviously a hard landing. Then it looked like, okay, maybe the Fed's going to be able to pull this off. They'll be able to slowly ease rates down, and we would have a soft landing. And then, so the hard landing folks are pretty much, no one's thinking at this point that we're going to see a hard landing in the next 12 months. So what's this no landing thing? It was new to me. And so on Ryan's episode, he gave a little clip, and basically what the thought is that we're not going to know what that landing is going to look like. I mean, there will be a landing eventually. It's going to be hard or soft. We don't know. But for the next 12 months, I think 36% of economists are now projecting we're not going to see a landing in the next 36 months, meaning there's not going to be enough significant action by the Fed to tell us whether or not there's going to be a recession or there's going to be a soft landing to this cycle of them raising interest rates and then ultimately when they lower interest rates. So 36% chance in the next 12 months, we're kind of just moving sideways here. We're circling, the pattern is circling while we wait to see what happens, which for those of us in the mortgage industry means a lot more of the same, unfortunately, that we've been dealing with, and not really what anyone hoped or projected, quite frankly, for 2024. So no landing, new term, but now you know what that is. As I mentioned, rates hit another high. That alone is going to put more pressure on CPI and inflation. So that's not great news. And then this is interesting. Travel's up. Matter of fact, travel is up above pre-COVID levels. However, spending on entertainment is down. Typically, when you see spending down on entertainment, it is kind of a sign of recessionary type environment. People start pulling back on spending on entertainment, but yet they're still traveling. So that might be more business travel happening. But entertainment alone seems like starting to wind down, which means that the average consumer is feeling pressure, right, in the market. So keep a close eye on that. Retail sales, as I mentioned, strong and continuing to be strong. So look, guys, to summarize it all up, where I see us right now is interest rates back to an all-time high, right? Or really close to it. Moving pretty drastically with anything that comes out from economic reports indicating what the Fed is going to do. Anything that supports the Fed being able to make a move is going to be seen very favorably. Anything like stronger retail sales, stronger CPI, which unfortunately we've seen the last 2 months, is going to have rates continue to get worse. And we're going to be kind of in this pattern, it looks like, for the foreseeable future until we see a solid direction on what's really going to happen with the economy. So with all that said, look, these are all things that I can talk to you about, I can report on here, but none of us have any control over what they are. I think it's important to be educated on what's going on. I mean, as mortgage professionals and real estate professionals, we get asked all the time from consumers, what are rates doing? What do you think they're going to do? And I think it's important that you have an answer to that. Here's what they're doing. Here's why they're doing it. Here's what I think they're going to do. And here's why I think that. Like, that brings a lot of value to people to be a resource and have a strong understanding of fiscal literacy and what drives interest rates, because this is our business. We should know that stuff, but we don't control any of this stuff. But what we do control is our actions, right? We control the activities that we participate in. And what I would encourage, and what I am encouraging loan officers to do every day, is to focus on the things that you can control. And those things are your prospecting, your calls, your follow-up, honing your sales skills, your presentation skills, really dialing in your borrower consultation and presentation, incorporating tools like Mortgage Coach, mortgage debt analysis, things like that really help you be an advisor to your clients to help increase your closing ratio when you do get an opportunity to work with a potential client. So those are the things that you can control, and those are the things that I would be focused on right now. I wish I had a more, happy kind of a message, but you know what? This isn't bad news. It's just reconfirmation or confirmation that things are going to be the way that they are. And I think we're kind of getting used to it, right? It's like cold water. You jump in it, but after a while, you acclimate to it. Hopefully, you've acclimated to this challenging market. Many people won't, by the way. So we'll continue to see both individuals and companies getting out of the mortgage space, either because they're forced to or because it's just not fun anymore. So the longer that this goes on, I think the better the recovery process is going to be. There'll be less people in our industry, more opportunity when that time turns. But for now, you guys, kind of status quo with interest rates in the market, but focus on the things that you can control. And I promise you, we will make it through this market. Applications are up. The amount of transactions out there's actually quite a bit of transactions happening. It's tough to go get your fair share. So focus on the things that are going to help you get your share that you need of those transactions. And you guys, that's my message for today. I hope this was a helpful update just on the overall tone of what we see going on in the market. If you enjoy this sort of content, we do put out a new episode every single Friday. Matter of fact, next Friday, I would definitely tune in because I'm talking with a good friend of mine, and we are going to be talking about prospecting and cold calling and building your database. A lot of tactical ideas, I think, are going to come from that conversation. So you're definitely going to want to tune in next week. And if you just want to make sure you don't ever miss an episode, just subscribe to our channel and you'll see every Friday a new notification coming out of a brand new episode here of Market Shares. Until then, thank you so much for your time and attention. Take care.